Today, we're diving into one of the most interesting puzzles in advanced accounting, the intra-entity transfer of depreciable assets. We're going to become financial detectives, hunting for what I call the ghost in the machine, the phantom profits that are created when a company sells an asset to itself, and how we, as accountants, make them disappear. Let's set the scene for our investigation. Able Company sells a piece of equipment to its subsidiary, Baker Company, for $90,000 and records a $30,000 gain. On Baker's books, they now have a new asset with a cost of $90,000. But from a consolidated, one company perspective, has a real sale actually occurred? No. All we've done is move a machine from one department to another. That $30,000 gain is a phantom. Our mission is to find and eliminate this phantom gain and all of its side effects from our consolidated financial statements. Our first step is to bust the main ghost, the $30,000 phantom gain. We do this with consolidation entry TA. This entry does two critical things. First, we debit gain on sale of equipment for $30,000, wiping the phantom profit off the consolidated income statement. Second, we must reset the asset's value on the balance sheet back to its true original historical cost. We debit equipment for $10,000 and credit accumulated depreciation for $40,000 to restore the accounts to what they were before the internal transfer ever happened. But the phantom gain creates a second, more subtle ghost, phantom depreciation. Because Baker recorded the asset at a higher cost of $90,000, its annual depreciation expense is $9,000. But the true expense for the consolidated entity, based on the original cost, should only be $6,000. This creates $3,000 of excess or phantom depreciation. We eliminate this with consolidation entry ED. We credit depreciation expense to reduce it by $3,000, and we debit accumulated depreciation to fix the balance sheet. This entry must be repeated every single year for the remaining life of the asset. Now we move into the years after the sale. In subsequent years, like 2024, the original $30,000 gain is gone from the income statement because it was close to retained earnings at the end of last year. The problem? The ghost of the gain hasn't vanished. It's now haunting our beginning retained earnings balance, making it overstated. We still need to eliminate its effect. To do this, we use entry star TA. The star simply tells us this entry relates to a prior year's activity. The logic is almost identical to our original entry TA, but with one crucial difference. Instead of debiting gain on sale, we now debit beginning retained earnings to remove the portion of the unrealized profit that is still remaining after 1 year. In this case, that's $27,000. The rest of the entry again resets the equipment and accumulated depreciation accounts to their correct consolidated balances. Finally, we must ask a critical question that affects our non-controlling interest calculation. Who made the phantom profit? If it was a downstream sale from the parent to the sub, then the parent company created the profit. In this case, none of these adjustments affect the non-controlling interest share of income. However, if it was an upstream sale from the sub to the parent, then the subsidiary created the profit. Since the NCI owners have a claim on the subsidiary's profits, their share of income must be adjusted. This distinction is one of the most frequently tested topics in advanced accounting.